let's focus in on the big deal for Reliance Retail, where they've are going to go really big on the e-commerce space. Their latest investment in the online furniture company Urban Ladder, where Reliance Retail has bought a 96% stake in the company via an all-cash transaction for 182 crores. They're going to make further investments, and they've proposed to increase their stake from 96 to 100%. Do remember that Urban Ladder has been under pressure for some time now. The company failed to raise any fresh capital from strategic investors. There's been heavy competition from the likes of Amazon, Flipkart, and even IKEA. And it seems like Reliance Industries is saving the day, although it has been bought at a lower valuation. Let's discuss this then in further detail. Ganesh of GrowthStory now joins in. Thank you so much for taking time out. And I really want to focus because you've got a very interesting take on this. There seem to be a plethora of opinions, and I'm going to just go with the more popular one, which says that, Urban Ladder selling to Reliance Industries for 182 crores after having raised 700 crores in the past is actually better than having to shut down, but it is a distressed sale indeed. But you're of the view that as of late, we have seen 90% startups fail, and therefore you can't term this as a distressed sale?
Yeah, no, I think one, obviously they have raised capital and they have sold for an amount that is lesser than the capital raise. That means the venture capital investors who have invested the capital have got only a fraction of the money back. So to that extent, it is not a great outcome from this particular investment for the venture capitalists. But what I'm really amazed by is the amount of glee and what the armchair critics talk about, how this is indication of why startup valuation is very high, why the valuations are not realistic, and all of that stuff. I think all that are wrong takeaways. I genuinely believe that it's a win-win for everybody. This is not a situation where anybody is crying, and there is no need for critics to say that, oh my God, this has happened, beat the chest and start deriding either the founders or the investors for believing in the company or valuing the company at a huge amount. All of that is, I think, completely unwarranted. If you look at the bottom line, the fact is that a business was created, a brand was created. It's an extremely tough category. Thousands of people were employed. Lakhs of consumers benefited. I, for one, have shopped 4 times on Urban Ladder. 3 times it was a faultless experience. The 4th experience, they were able to resolve it. I enjoyed the design, enjoyed the experience both in the physical store. So I think it's a win-win. What do people want? Do they want that Urban Ladder founders had never started this? Would that have been a better outcome? Nothing. And believe me, nobody is crying. As far as the venture capital investor is concerned, they invest in multiple companies. It's a portfolio approach. 2 out of 10 give them mega returns. And these are talking about top venture capitalists. They are not crying. The investors into VC firms, I'm an investor or what they call as limited partner in 7 venture capital firms, perfectly fine when many of them go bust and they lose money. What's more important is those 2 out of 10 giving a mega return. That is what gives me return as an investor. So I think it's a complete win-win. For Reliance, it's great. Large corporations cannot do startups. They don't have the DNA. They don't have the mindset. They don't have the ability. So for them, large corporations are good in taking something that is already happening and scaling it big. 0 to 1 has to be done by startup, which is what Urban Ladder founders with venture capital money have done. That 1 to 100 has to be done by corporations like Reliance. I think everybody benefits. I don't think we should cry at all about this. Obviously, people would have loved it if there are mega returns from this, but this is perfectly fine. That's my take on it. Don't pull down, don't diss the founders or the investors, celebrate it. And if you're one of those armchair critics, you go out there, start a company, employ millions and thousands of people, create thousands of jobs, do it, and then criticize or complain.
Yeah, no, you have said, that 90% of startups have failed, but I think it's probably stemming from the fact that there were eye-popping valuations not even longer than 2 years ago, 1,200 crores in 2018. Of course, that dropped to about 750 crores in 2019, and now finally it's crashed sub 200 crores. Perhaps that's where it is, of course, stemming from. But just let's talk about the kind of journey that the company has been through and some of the key concerns of late, and that has definitely been its inability to raise fresh capital. The talks with a lot of strategic investors failed. The kind of net loss that they have reported in 2017-18, 26-17, 2016-17, pardon me, and the capital shortage as well that affected their operations and growth of the company. Where do you think Urban Ladder really went wrong?
You have e-commerce. There are two kinds of e-commerce companies. One is horizontal e-commerce, where Amazon and Flipkart and companies like Snapdeal, they play a role. And then there are few vertical domain-specific e-commerce, where you cannot be another tab or another category on a Amazon, Flipkart horizontal, but it has got to be on its own. For example, furniture, fine jewelry, like what Blue Stone or Carrot Lane does, or grocery, like our own Big Basket or companies like Grofer does. So there are few domain vertical e-commerce which cannot easily become one more tab on a Flipkart or Amazon. So furniture happens to be in that category. It is a very tough category to begin with to be able to pull off. It is infrequent purchase. I get a customer, he's not going to keep on buying furniture again and again like they do with grocery or with other stuff. So infrequent, high inventory cost, logistics is very hard. Third floor flat, you have to take a sofa and put it out there. Now that is not amenable to Blue Dot courier shipping, like the way you can do with jewelry or other products. So infrequent, high touch category, high inventory costs, all of these are challenges. It's a very fragmented market. There were no brand earlier. Experience is broken. In that, they came in and did that. Now, unfortunately, they did right thing by opening guide stores, by opening offline stores, because people like to browse. I've been to the Urban Ladder offline store in Inner Ring Road in Bangalore and Koramangala. It's a beautiful experience. Same is true with Pepperfry, which is a competitor of Urban Ladder too. Excellent experience. When I purchased my furniture, I went there. But when nobody expected COVID to hit, COVID hit. And it is a bad situation for anything to do with retail or with physical stores. Even before COVID, they struggled to raise money, because raising money at higher and higher valuation is the way venture capital and this particular sector game is particularly played. If you're not able to raise money at next round, you will face huge amount of stress, because it's not going to be profitable. It's known that it's not going to be profitable. The fact that you need to raise next money. So this game is such that if the next round does not get raised, it will shut down. But that's fine. Many of the, out of 10 companies, 5, 6, 7 will shut down. That's perfectly fine. I think that is what has happened. Inability to raise capital, COVID hurting the hybrid model of offline stores created the problem. I don't think Amazon, Flipkart thing was a challenge, because those people are focused on electronics and mobile and high value items. While they do have furniture, I don't think they are a serious competitor to Urban Ladder or Pepperfry. Singularly, inability to raise money because of getting investors to bet on this, especially at a COVID time when everything went into paralysis and they were out there to raise money. It's an unfortunate time.
So, would you compare this to the like of the similar distress sales that we have seen in the furniture space in the past? The fact that Future Group acquired Rocket Internet, backed Fab Furnish for 20 crores. You had Mabel Card, which raised about $20 million, and then they were forced to shut shop. Ask Me closed their operations because of their exit of Astro Holdings. Would you compare it to the likes of these? How would you pitch it vis-a-vis some of these other similar sales, distress sales that we've called it in the past?
No, I think here we have a situation which is far better, because Reliance is a very good buyer. They are paid much lower value than the capital that was raised. That is a fact. But still, 180 crores is nothing to be sniggered at. 200 crores is a good value for a business. Don't compare it with the amount of money that invested in. So with 200 crore gone in, they will invest in the business further. They have said they are going to invest more in the business. They will take the brand. So I think it's a great outcome for the employees, for the vendors, for the suppliers, even for consumers, because the work that has been done by Urban Ladder would be further strengthened by this. So while it is lower than the capital raised, I would not call it distress by any means, and it's not going to get shut down. It's not a just a roll up or acqui-hire or a tuck-in that they will do that stuff. So this is lot more positive than the other deals, other deals that has happened, and that's it's very good for everybody in the system that Reliance has come in and is going to take over and is going to run the business. They will invest further in the business.
I just want to, understand from you what kind of a message this move gives some of the other startups, some of the other entrepreneurs, particularly with the message of, building a more fundamental, a sustainable business model. What exactly do you think are some of the key lessons that need to be learned from this deal?
See, hindsight is always easy. Okay, right? If I were to look at the hindsight and I were to go back and I want to advise the founders, I would have said, sit on the capital, burn lesser, try to be more conservative. But that's very easy to say post-COVID when nobody expected a once-in-a-century pandemic to happen. So that is what has happened. So hindsight lessons are very simple. It is not that these are unknown, these are not things. If you are not dependent upon next round of capital raise at a higher thing, you would be better off because you control your destiny in your own hands. But these are all motherhood statements, okay, right? These are all known statements. E-commerce business, high burn business, high growth business depends on risk capital as the fuel. It does not depend upon reaching profitability and being self-sustaining model. It's not a services business. It's not a lifestyle business. So I'm not able to take too much onto this. Specifically, if anybody had expected COVID to happen, they all would have done the same thing. Sit on cash, conserve cash, don't go for expansion, don't worry about next round. Try to extend your runway to 24 months to 36 months. Those are the very standard messages, but I don't think that would have been helpful in this case because COVID was not there. They were the market leader in an extremely tough category. They had the best chances, along with Pepperfry, perhaps, of raising money. I don't think I would have done it any differently other than maybe conserving some amount of cash and going in for lesser expansion. But that, again, like I said, is hindsight. Easy for me to sit in the armchair and talk about it. But if you were running it like the founders did, I would have done the same thing.
Okay, thanks very much then. Good to at least analyze the situation once all is done and dusted and really talk about your viewpoint. So interesting to know that you would have done things the same way. And as of now, it's a win-win situation for both the companies and good for RIL as well with this foray into the online furniture segment. On that note, let's take a quick break right here on the show. Stay with us. We've got lots more lined up when we return.